Everybody, welcome to the podcast today. I'm stoked to have David Elmore. David is with Experians Clarity Services. He's a data solutions consultant. And if you've been in auto for a minute, you know him. He's been the face of alternative data as far as clarity is concerned. And he's had an interesting career path as it pertains to acquisitions and stuff. But David, welcome. Yeah, I definitely want to get into that, by the way. Welcome to the pod, David.
Thank you, Joel. Appreciate that. Yeah. I would say my journey over the last 20 years has been interesting. As far as my credit bureau experience, I started with Experian in Schaumburg, Illinois, way back in 2001. We'll call it my first job out of college. I may or may not have had a bartending job or something here or there before I jumped into my professional career. And then wound up moving to the West Coast in 2005 with Experian, worked there and continued my career there for quite some time, and then had the opportunity to join Clarity Services when it was just Clarity Services in 2016. And then lo and behold, we were acquired back by Experian. And so, luckily for me, my old employee number did work, and I was allowed to come back and continue on with the, data solutions consulting practice here at Experian. So very blessed to have my career path.
So for folks that don't know about, you can call it alternative data. You and I were talking beforehand, and maybe the proper moniker is the expanded FCRA data or the expanded universe of variables. First off, let's establish this: Clarity, Experian, they are CRAs. So if you're looking to use this for all of the legal reasons why you would evaluate somebody credit, it's not that you're taking variables that were acquired from their social media experience or something that is not FICRA compliant. So first off, let's just establish that. But I want to get into some of the background, David. Like, can you give us a little bit of a journey down the historical path of how alternative data came about, who was using it, how it was being used, and how it kind of worked its way into auto?
Yeah, no, that's a great question, Joel. And I'll give you the history as best I know it. There were some individuals back in, I would say, coming out of the financial crisis of 2008, right, that saw an opportunity to really kind of catch everything that the traditional bureaus weren't. And what I mean by that was consumers that are applying for alternative finance products. And alternative finance products could range from, traditionally back in 2008, 2009, your single pay loans, or, as they're commonly referred to, payday loans. And that's really where the industry started. But it's evolved into online installment loans, auto title loans, online installment being the biggest segment. Rent to own is another segment that's really, expanding as you think about alternative finance products. And so what these individuals did that started these bureaus or specialty credit reporting agencies like Clarity was they formed relationships in a consortium database where these companies reported inquiries and trade lines exactly the same and exactly as compliant as FCRA, as the traditional bureaus, to Clarity. And then Clarity in turn, captured those into a database and have since, built attributes and products to, really enhance decisioning in different capabilities throughout the consumer life cycle.
Yeah. Yeah. And that's, there were a number of players we talked about, right? And then, so it seems that the path has been that they've been absorbed into the larger, traditional credit bureaus, and Clarity is no different. To me, that gives me a little bit more confidence and surety, to be honest. Like, I think,
yes,
there's obviously a little bit more bureaucracy you may face, but from a, like if you're looking to securitize or do something like that, right? Like there's some scores out there, bureau scores that are really great, but they don't package well when you're securitizing something. And I think that this is a great way that you can expand. We talked about, expansion to provide better financial inclusion to people. These programs really can help with a lot of that. You mentioned earlier, David, that traditionally the alt data as it was used, expanding into like new markets, right? Like in auto, you're saying, hey, you can use this data. They were initially using it as knockout rules, right?
Initially, yes, that's a great point, Joel. And so as as the databases grew, there were folks using it, and when I would say early adopters were looking at it as, okay, someone in the, let's say, Clarity database is inherently more risky, right? And so I'm just going to use a hit no hit flag or some kind of small set of attributes and really just probably assign more risk to that individual. But as we've seen, the products evolve to the online installments, which are 6 to 36 month term loans that may be $1,000 to $4,000 balance. Putting a monthly payment anywhere from $250 to $500. So as we see the products pivot, the consumers also have an opportunity to be emerging consumers, right? And that may be consumers that fell on hard times, or consumers that came to this country, didn't have an established credit history, and found an alternative finance product and are paying their obligations on time. And that robust history is really how the alternative finance bureaus, the specialty bureaus like Clarity, have grown, right? Especially over the last 5 years, the amount of emerging consumers that are able to help serve the underbanked and give you an extra lens, if you will, at the time of application to see, wow, that consumer is much better than I really thought they would have been with my traditional model, right? And so it has given a whole new world of opportunity, and we may talk about that later. Some of the really blended scores that we've built here at Experian in particular, and I know there's some other ones out there, have combined several data sources so that consumers, we almost can score the entire credit eligible population, right? Really making sure that the inclusion aspect is there.
Yeah, and I think that's something that really needs to get out there for everybody to understand. Obviously with my role at the NAF, sometimes we'll take some questions from media, and they'll pour through reports, or they'll pour through industry articles, and they say, well, we looked at a population of people with a credit score of X, and we saw this disparity, and we don't understand why these people got loans or got these terms or whatever. And I think there's far more to it than just the credit score itself, right?
Yeah.
Yes. And particularly once you get in the subprime space, what lenders tend to do, and I want to make sure that folks understand this, is what lenders tend to do is they say, the efficacy of me just underwriting a borrower in this lower tier is not, just running off the credit score is not enough, right? I have to break that credit score into smaller pieces, into individual variables, and then identify which of those variables have the most predictive power, and essentially build my own model. And so, yeah, you might be right that there were some screwy things when you were looking at the FICO and how people were distributed, but there's a reason for it. And I think of Clarity as pulling in more of these data elements that I think are relevant. You mentioned one that's really good, and I'll blow up Daniel Perry, because he taught me this, which was just by seeing that there was an existence of an inquiry from a payday place, or the existence of a payday loan on the trade, which doesn't always show up on a traditional trade, right? Sometimes they'll just report to the alt CRAs like Clarity. Now you're picking that up, right? You talked about the consortium. So now we have a closed loop system. And I think it just, to your point, it can really enhance your modeling. Are you finding that, David, are you finding that some of so I can see more of the innovative, forward-looking finance companies getting into this, but are the traditional banks and credit unions starting to embrace this? Because I haven't kept the tabs on whether they're using alternative data or not.
Yeah, that's a great question, Joel. And I think, that goes back to one of your earlier points that, once the acquisition happened, right, and Clarity started to fall under the umbrella of Experian and take what was already an FCRA regulated database and combine it with the Experian experience, if you will, in model governance and in building traditional models, right? And then putting them through rigorous processes and things like that to make sure that they are completely compliant and inclusive and things of that nature. I think that's where, I wouldn't call it validity, because there was definitely validity in all the scores before that, but I think it really gave it some street credit, if you will, these scores, this data, because it is being regulated by by one of the traditional bureaus. It's being combined, and the teams are working together. And so in that spirit, yes, I mean, there are traditional auto lenders, there are traditional banks and credit unions using this data in a variety of ways. I mean, you may have folks in the traditional world that are more of a prime institution, maybe just using a small subset of attributes, right? Mm-hmm. But those 10 attributes they find are extremely predictive for their population when someone in their population, even if it's only 10%, has presence of alt finance, what that means, right? They have found statistically valid reasons to use this data, even if they are a traditionally prime institution. And so I would say that once the analytical work is done, you can find a off-the-shelf score, a set of attributes, a blended score, a multi-bureau blended custom score, right? That's built by a third party to incorporate this data full spectrum. So it's not just a subprime use case, right? Mm-hmm. It's, the consumers that are in the database tend to fall in that category. But as far as how to apply it, to me, knowing that a 780, let's say traditional scoring consumer has alt finance activity would be just as interesting to me as a 580.
Yeah.
Right. I mean, because to me, okay, well, what am I not seeing with this, consumer that has a 780 from an alt finance perspective that, may be telling at the time of application? Because I think there's one other thing to think about too is, using this data is not just to feed a model for a straight approved decline, right? There's a couple different aspects to it at the time of application or decision. There's approved decline, of course, but there's also risk-based pricing, right? There's pricing strategies that go along with this, especially in auto finance, right? What tier do I want to put this consumer in? And does their alt finance product usage and either meeting obligations, not meeting their obligations, allow me to move them in my tier, based on what they're doing. And then finally, there's also, given the frequency and stability of some of these consumers, right? When they're accessing alt finance, a lot of times this activity is very fast. We may see a consumer 10 times in the last 10 days, right? Because this online world and they're shopping. So in seeing that and capturing all that, there's actually a level of verification that we can actually tell you. Meaning, if we've seen the same consumer 10 times in the last 10 days, and that consumer is giving us the same social, the same cell phone, and the same driver's license. So, they are who they say they are, but we've seen 7 different work phone numbers, 9 different net monthly incomes reported, 4 different home addresses. There's a bit of instability there. That doesn't mean they aren't who they say they are, but there might be a little bit of an intention of what I would call first-party fraud, not third-party fraud.
Yeah,
and that's
stopping you.
Yeah, it's the intent not to pay, right? And so third-party fraud is obviously, know your customer, and we're not telling you that because they probably are who they say they are, but they might not pay, right? And so there's also that element to the data too. Yeah. So I think that's where it just enhances that, look at the time of application.
I think it's great to use to expand northbound in the credits. Oh man, I had a comment, but I've completely lost it. I think, my coffee ran out. I'm going to David's wonderful wife brought him his coffee, and I don't have the same setup.
I have to echo that. I do work out of my garage, but it's next to the kitchen, and I can make requests now and then. So it's a very good system. If you hear my daughters in the background, this is definitely a witching hour right after breakfast right now.
Oh yeah.
We'll try to keep it down.
Well, I remembered my thought. Thank you. The alt data has applicability up north, right? To prime, even potentially super prime if you're really splitting, the finer points. But the other thing again, I'm gonna pick on the media. They had a question about people with certain FICO scores, and buried within the question, it was assumed that because you had a 5-something FICO, that you don't make money. It was just assumed in the question that the person didn't have the financial capacity to afford this loan or this payment. And I thought, that's not the case, David, right? Like you could have a 500 something FICO score because you just had a bunch of stuff happen in your life, right? and maybe you went through a nasty divorce and your ex-spouse was spending all the money and not being and you got sucked in. Okay.
Yes.
You still have this killer job. You're making 200 something $1,000 a year and everything's great with you. You just got hit in the gut. So you can't just blanket, like, assume that somebody in these lower tiers falls into a certain category. We have to open our minds a little bit and realize that there are pluses and minuses to some of this data. And I really credit the folks like you that are helping to keep the needle moving so that we see what's available to us so we can keep enhancing and expanding.
Yeah, it's a great point, Joel, because we call them life events, right? It could be a variety of different things that happen to put that FICO down in a range where not only are you labeled with that FICO, but you can't get a loan anywhere.
Yeah.
You can't go get $2,000 from a credit union with a 550 FICO score. It's just, it's too hard to do that. It doesn't fit into the box. And so therefore, these alternative finance products are the only place to turn, and yet they're not reported to the traditional bureaus to feed that FICO or Vantage score potentially, and therefore that stays the same. And so that's where this data can really help, move the needle, and just really meant to be supplement and augment those scorecards, right? It's not meant to replace the traditional, we'll call them generic scores or traditional scores that we know and love, right? It's meant to supplement those scores and make sure that you're seeing the full picture, because you've got folks that, and that's one of the things about the application that we talked about, those attributes that we get. We get on average around 25 pieces of information on every application when you talk about an alt finance provider that provides data to Clarity. Now, think about a traditional bureau. If I go to apply for a car loan tomorrow, it takes about 3 data elements to get me on the application. I put my name, social, and address, and you can open the door and find David Elmore's file at Experian. It's not hard, right? That's all you would need from me. Whereas these Clarity folks, are these folks that report to Clarity, since these are higher risk loans, higher APR, and faster moving, they require more information. And so we're taking that in and ingesting it every time. And then when you think about it, one of those is net monthly income. And so when you talk about that consumer that may be making $200,000 a year, but they have a 550 FICO or Vantage score, and they've been taking out installment loans on a regular cadence every 6 months and putting that they make $5,000 a month on every one of those applications, we have an attribute that would tell you we've seen them 6 times in the last year, and every time the median reported net monthly income is $5,000. That is something that can be used to enhance that consumer's profile, right? That, because to me, if they report that 6 times and we've seen it 6 times, is it verified? No, but it's pretty darn good stated income.
Yeah. Yeah. Yeah, and you got to think that people are verifying that at some point. If he's gone, if this individual has gone 5 different times, somebody's got to be verifying that, and then you see if something got pushed through, and then you see the performance, right? I mean, there's a full scope of picture you can see. I love the concept of automating a lot of this stuff, and so the old school folks, because I came up through the manual underwriting, and then automating stuff when I was at Capital One back in the mid 2000 first part of the century here. We were just kind of scratching the surface on some of the automation because there's auto declines, auto approvals. You got to be careful, right? You can end up cutting off your nose to spite your face. But so I think about folks are at various levels of sophistication, right? So take a small regional auto finance company, largely does judgmental manual underwriting, maybe branch based, right? So even that logic is somewhat distributed versus like a very large financial institution, been in business for a while, and maybe they have vast resources and an automated scorecard. So take these 2 examples, David, and give me an example of how Clarity might be able to, through just tactically speaking, like engage them and help them kind of enhance their, is there a path for people? I guess my question is there a path for people that are small and not very automated versus somebody large and automated? Do you have like a path for how each person could experience some of the Clarity pieces and and see if it's right for them? Like, what's your process for that, I guess? Yeah.
Yeah, that's a great question, Joel. And there is, both sides to the coin, right? There's the manual. We have products that serve that. And then there's, of course, the, big machine learning engines, right? That crank out hundreds of thousands of applications a year. And we can feed those models as well. But I think that, the number one thing to do is when you want to explore alternative or expanded FCRA data is get a comprehensive data set and back test, right? Or retrospective analysis. Some people like to call it a vintage, and work with the bureaus to say, okay, I'm going to go back and take all of my applications from 2018 or 2019. I'm going to attach a performance measure to it. Something like ever 60 days past due in the first 12 months. And then what I'm going to do is at the time of application, I'm going to look at an off-the-shelf score, maybe some attributes, and then I'm going to test it and see what I might have done differently from an approved decline, from a risk-based pricing, or potentially even some kind of additional stipulation, passing it on for additional verification process at that time. And working with the bureaus in order to do a retrospective analysis like that, I myself personally have done in the last 5 years. I've literally probably done over 100 of them with institutions from as large as you can imagine to shops that process 1,000 to 2,000 applications a month. The beauty of the retrospective analysis is that it's empirical data that really doesn't lie, right? Yeah. If there is lift or statistical validity in adding a score or attribute to your process, and we can show you that you would have made better decisions at that time and the performance would have wound up X, then that is really how you would think about going about using this data. I wouldn't recommend ever just grabbing this data and starting to use it without some kind of back test, right? I think a retrospective analysis is the best way to do it. Now, when you're talking about the smaller, independent, indirect auto finance shops, an off-the-shelf score is most likely probably going to be your best bet, right? Because that work has kind of been done for you, right? Our off-the-shelf scores are very custom.
And let me pause you right there. So there's a reason for that. So if I'm the small regional lender, I may not have the magnitude of historical data or stability of underwriting within my process for you to glean that. And so what I can do is I can lean on a larger population of like lenders, like customers, like collateral, like dealerships, and essentially infer based off of people that look and feel and taste and all the same,
That's right.
And you're kind of doing that. And there's a tremendous amount of value in that. And it can definitely keep you collared into upper and lower control limits to say, we used to buy people that look and feel like this, but given that we saw that there's a really, it's just a no-win if they exhibit certain characteristics. Let's just decide to kind of pass on those.
Yes, that's right. And that's a great point you just made, Joel, is that, the key to a smaller or, mid-sized institution using the retrospective process to glean insights off of the industry to kind of set their parameters along with their own backtest information is really a reason to use that, off-the-shelf score. And then we get into, folks that are using, attributes to feed a larger custom model. There are also other ways to use it, right? You can take this data and put it at the top of a waterfall and use it as a set of business rules. You can, use it at the end as a set of verification or extra stipulation rules, right? So really along the process of application as we know it, automated or manual underwriting, there's a place to put it, but I would highly, highly recommend some type of deep analytical work in order to do that, right? It really is not recommended to just grab it off the shelf and say, you know what, I'm gonna start pulling this score, and everybody below 650, I'm gonna do this, and everybody above 650, I'm gonna do this. I think there's definitely, it needs to be looked at as a supplementary and complementary data source that, gets statistical validity from an analytical study.
Yeah. So for folks that are listening, obviously you can tell from David, he's been doing it a while. He knows what he's talking about. David, I've known you for a while, and I've found you to be very insightful with a lot of those things. And I encourage folks to reach out to David, or look, if David doesn't answer his phone, there's this other guy, Scott, you can call. But anyway, we'll worry about that another time. But David, we're almost to time here. The diversity and inclusion and all that stuff, it's quite a hot topic right now. I think it's going to continue to be front and center from a regulatory perspective. I've been reading market reports that are calling it out that prior didn't. I mean, I'm talking like ABS reports and monitoring reports saying we're throwing this concern in the bucket. What's your thought or Clarity's thought in how you all are participating in that and kind of helping companies make sure that they are providing, good, diversity and inclusion opportunities to all their borrowers?
That's a great question, Joel, and I'm glad you asked that before we ran out of time here early on a Friday morning. I got to get to my day job here, but no, I'm just kidding.
You got two little girls running around, man. It's the witching hour. Come on.
So when you think about what we're doing for diversity and inclusion, I'm glad you asked that, because my answer is really twofold. And that is, we talked a lot about Clarity today, and that was kind of the purpose. But, Experian overall is dedicated to, acquiring many more enhanced FCRA data assets. We already have rental data assets, banking assets. We have trended data. In addition to that, Experian also likes to partner with third parties and actually allow access and build scores that combine with some of the data assets we already have in order to get a more inclusive score, right? So we're never stopping the effort to include as much data as possible to make sure to score the entire credit eligible population. And I want to reiterate that point. The credit eligible population, when you estimate that number, it's probably close to, at any given time, around 220 to 230 million consumers, right, that are credit eligible. When you think about traditional or generic scores, they can probably score around 80 to 90%. Experian has just launched a score that actually includes Experian data, Clarity data, trended data, and actually a third-party data source that we have found to score approximately 96% of the credit eligible population. We're talking about bringing an entire group of thin file and underserved folks.
We're just,
right?
And all we're talking about there is we're covering this percent of the market. We're not telling you that we've got the full answer. It's just we have something there to cover the 96%. That if you're going to feed it into a model, whether it's enough or not would depend. But that's significant, because, these zero scores, no scores, somebody that's a ghost, it's just not a lot of information there. You kind of are relegated to using a lot of non-bureau related type stuff, right? Like,
that's right.
Talk to your boss. Let's make sure your job is stable. Let's talk to your landlord and find out if you've really been living there for 4 years. That's, it's nice to not, it speeds up the process. It makes it better for the consumer. It's a lot less intrusive. Right. I wouldn't want somebody calling my landlord all the time every time I wanted to take out a line of credit or something. They get annoyed. They get annoyed. Yes. I remember my wife works for a government contractor, and they don't do job verifications. If you're not in the work number, like we were trying to refi our house, and we were doing it through a broker, and the guy said the people that they just want to talk to somebody to make sure that your wife actually works there. And she said, well, they're not allowed. Like, I could ask my buddy, who's my manager, to talk, but he's doing something he's not allowed to do. I mean, there's tripwires all the way around. And I think the more you can make it smooth, you give people dignity, right? I felt like kind of a piece of garbage having to continually ask my wife, hey, can you please just ask your boss to just take this call? Like, I get it, but but this lender wouldn't take the work number for whatever reason or another. I don't know why.
And that's really the goal of this new Score Lift Premium is to get full comprehensive coverage. I mean, there are always going to be folks that live off the grid, but boy, if we can get to 96%, 97% by bringing in public record, professional licensure data, along with alternative data, traditional credit data, trended data, you're really trying and doing everything you can to give everyone a chance and be completely inclusive, right? And so that's the goal at Experian, is really as the Consumers Bureau is to try and make sure that everyone is inclusive. We serve the underbanked and really make sure that everyone has a fair chance and fair lending. Right?
I love it. And David, you've been swinging in this space for a while, and you know what you're talking about. folks. You can tell he's obviously passionate and well-informed, a great guy to boot. David, for folks that are listening that they just want to learn a little bit more, what's the best way for them to get a hold of you or someone on your team?
Oh, absolutely. No problem. You can reach out to me directly. My email address is david.elmore@experian.com. I'm sure we can send it out after this email, but you can also, look online, and if you get a hold of, Clarity through just our standard marketing, leads will come in and come to myself or one of my teammates. But if you reach out, we will do everything we can, to make sure that everyone is heard and assigned, and make sure that, you get a chance to look at the data, right? I mean, the key to this is that, you want to let the data speak, right? I mean, of course, we could all sit here and talk about this, Joel, right? I mean, you and I could probably sit here and take up most of Friday if we wanted to. But at the end of the day, when you want to get down to it and what we look at doing, let's get to the statistics. Let's get to a validation. Let's look at the numbers and see what can help your organization make more inclusive, fair lending, and still yet risk mitigating decisions, right?
Right. That's right. Well, David, thank you so much for kind of shedding the light on this. And this was good to walk down the history of expanded FICRA data, that maybe we can start a revolution and get people start saying that as opposed to alternative. I think it's a better, a better term. But once again, David Elmore of Clarity, a part of Experian, a fantastic guy. David, thank you so much for joining us today.
Joel, thank you so much for having me. Appreciate it. It's great to chop it up with you on a Friday and talk about alternative expanded FCRA data. And I'm looking forward to seeing you in a few weeks at the NAF conference out in Plano.
Conference, that's right. August 30th to September 1st. And for folks that have questions about it, it's still a go. And I'll be at NIADA the week prior too. So looking forward to seeing folks. David, thanks again.